Welcome to Target Professional Consults. Today we are going to continue the IAS 16, that is the subsequent measurement. Good. Kindly be with us and then let's go through together. So the subsequent measurement of IAS 16, that's property, plant, and equipment. Great. Now let's go to the board. So IAS 16, that is property, plant, and equipment. PPE. No, good. We are looking at the subsequent measurement. Subsequent measurement of PP. Please, if you have not gone through the initial measurements, kindly do so before watching this video. And kindly subscribe if you have not done that. Thank you. Great. With the subsequent measurement, the entity has to choose between two models. So select one. This is a matter of what policy. So the first model is the cost model. Cost model and the revaluation model. Revaluation model. Good. So we look at the cost model, what it states, and then the revaluation model we are done. Here, subsequently, we said that initial measurement, if you acquire the asset, the first time you acquire the asset, what will be the value? We call it initial measurement. How to obtain that value? We'll go through initial measurement. So initial measurement. Then the next reporting period, maybe December the next year, you bought it 2010. So 2010 December. What about 2011 December? So subsequently, after the initial measurement, after the initial value, the next reporting period, what will be the value? Now, the standard is saying that when you go to the subsequent measurement, relax. There are two models. Select one. So it's the method of policy. Good. Now let's look at the cost model. What does the cost model say? In fact, all of them, we are looking for a value to be placed on the asset, and that value we call it carrying amount. So all these two formulas, they are all these two models or methods, they are just giving us a method to arrive at what the carrying amount. So all of them, they are looking for carrying amount. Just that the direction that this one is coming from is a bit slightly different from this direction, but all of them are looking for one item. Good. So now let's see. First, let's look at the cost model. Now, under the cost model, we are seeing that the carrying amount of an asset, carrying amount of assets is equal to the cost of the assets less what any accumulated depreciation less any what accumulated impairment loss. Good. So that is the cost model. Good. So if you want to get a carrying amount, the cost of the asset, this cost is coming from the initial measurement, the initial cost, then the accumulated depreciation, less any accumulated impairment loss. So that is the carrying amount. Good. Now, in IAS 16 particular, most of our calculation, we will end at the accumulated depreciation. Why? Because this is standard on its own. IAS what 16. Good. This is IAS 16 impairment. Sorry, IAS 36. IAS 36 impairment. Good. So basically, in IAS 16, we normally end here. So when you go to IAS 36, you can combine the two together. You can also combine the two together and then test you on. So that is it. Now for depreciation, let's look few it's about depreciation. Of course, we have look at it at the initial measurement level. Now, what we've not done is the accumulated depreciation. So depreciation. Depreciation. Good. At this stage, the central focus is not about the calculation. But the examiner assumes that it's the second floor of depreciation. Good. Now let's see. Depreciation is a systematic allocation of what? Of the depreciable amount over the asset life. Systematic allocation. So let us know you have an asset. It costs you 1,200. This 1,200, we assume that let's assume that it lasts for 4 years. 4 years. I'm going to use it for 4 years. Maybe your mobile phone, 1,200 series. You're going to use it for 4 years. So it means that every year, a portion of this 1,200, you're going to consume it. So if I want to calculate the part of this 1,200 that will be consumed, then I have to divide the 1,200 by the 4. So I'll get what? 300. So on average, every year I'll consume 300. Every year. That is the depreciation. So depreciation is the systematic allocation of the depreciable amount over the asset life. That's depreciation. You can also explain it as the part of non-current assets consumed by its owner during what? Each period of use. Or you can also state that depreciation is what? Fall in value of an asset or loss in value of the asset. So part of the asset value they are going to take off. Good, but are going to consume during each period of use. Now we have 5 methods of charging depreciation. And you should be aware of all 5. Basically, 3 of them are common. 3 of them are common. So first, 1, straight line method. Great. So straight line method or equal installments. Your depreciation is on cost. Depreciation is on cost. That's another term for it. Depreciation is on cost. So 2, reducing balance. Reducing balance. Your depreciation is on net book value or current amount. So say sum of years negatives. Sum of years negatives. Then what? Production hour. The production hour method, and then the unit produced. For the 4th and the 5th are when so production hours, and then the production unit. Or we can state it like a machine hours. So machine hours and then the production units. Production units. Good. So these are the 5 ways of calculating what? Depreciation. Good. So 5 ways of calculating depreciation. And you should know all. So kindly join us when we are solving questions. We will pick a question, solve it on each stage. So straight line, reducing balance, sum with the gates, and then machine hours and production unit. Now, how do you treat the depreciation? So now we've gone through the methods. All of you just will prescribe a basis of what arriving at the value. After you get a depreciation value, how do you treat it? Good. That is it. Now let me explain some few terms here, especially with the first two. Let's look at the formula for the first two. Straight lines is cost of the asset less what the scrap value, all divided by the number of years. The cost minus the scrap value is what we term as what? The depreciable amount that will suffer depreciation. The depreciable amount, that's the top one, is the cost less the scrap value or residual value. And let me write it here. So for the straight line, depreciation is equal to cost of the asset less what the scrap value divided by estimated useful life of the asset. Useful life of the asset. So let's assume that your mobile phone, which costs you 1,200, at the end of 4 years, you can sell it for 200 as scrap. So let's see. So therefore, depreciation will be 1,002 less the 200. Why? Because this 200 will not suffer for depreciation. Depreciation is the part that you are going to lose from the value. So out of this 1,002, you use 1,000 and then pass on the 200 to someone. That 200 should not be depreciated. So that's why you're lessening all divided by 4. So meaning every year the asset value must be reduced by what? 250. So when you go to the last year, you take it off. Good. Sorry, let's go up more. Okay. So basically, that is the depreciation. Now, when you go to the reducing balance method, the formula 2 will be depreciation is equal to, it will be different. Straight line, you charge the same year, but you charge the same amount or constant amount or equal amount over the year. Here we assume that the asset life or the asset value reduces at a constant rate. But reducing balance method is not like that. That one, depreciation will be equal to the cost of the asset plus accumulated depreciation before you multiply by the rate. Here assumes that the asset value reduces at a constant rate. So every year, 250 must be subtracted. That is the straight line. Reducing balance says no. The asset value reduces at a what? At a reducing rate. So if this year you charge, let's say 8,000, next year you charge something like 7,500. The following year you can charge something like 7,090. The next year 6,595 in that order. So that is reducing balance method. We are done. So can you join us when we are solving questions on them? So basically, we are done with the calculation of the depreciation. Now let's go to the treatment. Some of the gates, well, we will illustrate it. Machine hours here, the asset life we translated into what? Into hours, operating hours. And then the production unit do the same thing. They move together. But the alternative version of straight line. If the asset life of 4 years, okay, this 4 years, how many hours are you going to use the asset? Okay, I mean for 6,000 hours. So the depreciation must be based on 6,000. If I'm using the production unit method, okay, within a 4-year period, I will just produce let's say 7,000 units. So the depreciation must be based on the 7,000 units. So it's the same as the straight line, just that the asset life will be translated into hours or units. That's the difference. So if you know how to depreciate assets on straight line, the same way going to adopt or apply for that of the machine hours or the production unit. Now let's go to the accounting treatment. How do you treat the depreciation after you've calculated it? First is an expense. So first, so accounting treatment. Depreciation is what? Expense. So first must be expense in what? In the P&L. Preferably either operating expenses or cost of sales, depending on the type of the asset. If it's for production, add it to the cost of sales. If it's for administrative errands, put it in the operating expenses. Second, then you subtract it from the asset value, from the cost of the asset. The value of the asset. So that's on the financial position, statement of financial position. That's what we do there. So in short, we will prepare what we call PPE schedule, and then we will take the accumulated depreciation. So we have something like this: cost of the assets, accumulated depreciation, and then the current amount. Maybe the cost is 30 for year one, 30,000. Or the depreciation charge on the asset so far, maybe 20,000. We take it off, current amount becomes year 5. Current amount is 10,000, then you are done. So this is the treatment in the statement of the financial position. You do this working somewhere, we call it the PPE schedule. Then you translate the answer to the statement of the financial position. We will look at all this when we start with the question solving. So now we are done with cost model. Cost model. Now let's go to revaluation model. Let's go to revaluation model. So the next model is what? Revaluation model. Revaluation model. Under this one also states. Now, revaluation model, all of them, we are looking for carrying amounts. All of them, they are looking for carrying amounts, whether revaluation model or cost model. Good. So the revaluation model states that if you want to determine the asset carrying amount, take your time, relax. Here, bring what you call the revalued amount. Revalued amount, also known as what? Fair value, which has been explained in the first video. So go through it and be fine. So revalued amount, also called fair value, less what? Subsequent. The word is subsequent accumulated depreciation. Less what? Another subsequent accumulated impairment loss. So that is the current amount under the revaluation model. Get the revalued amount, less any subsequent accumulated depreciation, less any subsequent accumulated impairment. Why subsequent? I will explain. Now the difference between the revaluation model and cost model can be clear. Over here, first, under the cost model, we said that the current amount is equal to, over here we said cost, right? Less just accumulated depreciation, less just accumulated impairment. No subsequent, no fair value. So have you seen the difference? Good. Now revaluation model. Here when you adopt it, sometimes the entity wants to mark the book value of the asset to that of the market value. So in that case, you have to adopt the revaluation model. If you want to make sure that your assets are stated at their current value or match the market value of it, then you have to state that what at the revaluation value or the revalued amount. So basically, that is it. Now the subsequent accumulated depreciation, the word subsequent is in because we assume that if you do the valuation, all the past details of the asset vanish from the. So you bought the asset here, January. 2010. 2 years later, that'll be 2011 December. You decided to do revaluation over here. So when you do evaluation, we are saying that all the accumulated depreciation that we charge on the asset so far preceding the valuation or before the valuation must be what cancelled from the book or released. That is it. Good. So in short, any accumulated depreciation that we have calculated before, prior to the revaluation, this is the revaluation date. So maybe you charge depreciation, the cost of the asset is 50,000. That is the cost of the asset. Depreciation you charge is, let's say, 5,000 each year. 5,000 each year. So that means on this day, the current amount will be 40,000. Then assume that the revaluation or the fair value on this day is 60,000. The revalued amount is what? 60,000. So that means depreciation that we can subtract will be the subsequent. So after the revaluation, the subsequent depreciation. All these depreciation prior to the valuation must be cancelled or released from the books. So that is the main reason for the subsequent. So that means after valuation, you're looking for accumulated depreciation. It must be the depreciation subsequent to the asset. So that doesn't that after revaluation, depreciation per year changes. So let's say 5,500. 5,500. Then it means that the accumulated depreciation that we can subtract is what? Is a 5,500 at this date, and here's 11,000 in that order. So you can only subtract the depreciation after revaluation, not before. That's what I call it. So at the date of revaluation, all the accumulated depreciation must be cancelled. So that means after revaluation, you only have depreciation subsequent to what? That valuation. Then we are done. Good. Now, there are some few rules that we have to take note when you adopt the revaluation model. Yes, because the revaluation model is highly subjective. So it comes with rules or conditions. Now let's look at the rules or the conditions of the revaluation. So the conditions or few rules that we have to adhere to when we adopt the revaluation model. Good. So rule number one. So conditions for the revaluation. Condition number one. There are three that I'll give out of the four. Condition number one states that the valuation must be performed by a qualified independent valuer. The evaluation must be performed by qualified independent valuer. Good. So it means that the accountant or the chief finance officer cannot perform it. Yes, the accountant is not a professional valuer. So we have to employ the service of a qualified professional valuer and must be independent, meaning there shouldn't be any influence directly or indirectly coming from the organization. Because if you are the employee with that of the organization, there might be some level of influence, and here we don't want that. So first, must be qualified, and then independent valuer. Good. So that is. Then the next condition is that if you do value a particular asset, the entire class must be revalued. So if a particular asset is being revalued, all the entire class must be revalued. So if a particular asset being revalued, the entire class must be revalued. Entire class must be revalued. Wow. What you're saying is this: assume that we have 5 tracks. We have 5 tracks. Probably 3 are in good shape, 2 are in terrible, bad shape. So you decided to revalue the 3 and leave the 2. No. Even if you revalue just a track, in fact, all the other 4 must be revalued. So if you have buildings and you valued 1, the entire all your buildings must be revalued. How we get it? So that it will mean like you wait when things are not good, and then you do the valuation on some certain asset and leave the other. No, the entire class. So building class, what again? Plants, then the motor vehicles. So that is the condition number 2. Now let's see condition 3. Condition 3. Now condition 3 states that the valuation must be performed periodically. So the valuation must be performed periodically. So that means select every year. If your period is every year or every period, you have to perform the valuation. Here, what we don't want is this. You wait as things are getting worse, then do valuation to change things. No. You must be consistent in the valuation. So if every 6 months, every 6 month value. If every 3 months, every 3 months do the valuation. With every year perform the valuation. Don't wait when things look horrible and you want to use the valuation to make things look okay. So that is the condition 3. Now let's see. How do you calculate the revaluation? How do you account for the valuation? First of all, anytime we perform revaluation, we'll have what we call revaluation differences. Revaluation differences, and we call it revaluation gain or loss. The revaluation gain or loss. So it means that when you revalue your asset, either you are going to gain, you're going to probably get certain reduction. So, how do you calculate the revaluation gain or loss? Yeah, what we do is this. Bring the revalued amount, so much revalued amount, which is the same as what? The fair value, less the carrying amount of the asset at the date of valuation. Less carrying amount. So therefore, the revaluation gain will be the revaluation gain or loss will be if it's positive, then it's a gain. If it's a loss, then it will be negative. Good. So that is the revaluation gain or loss. That is the revaluation gain or loss. So now let's look at accounting treatment. Can you be with us when we are solving the question, the calculation of revaluation gain or loss? And then you'll be fine. Now, if it's a gain, it has a specific treatment. If it's a loss to a specific treatment. So let's look at the revaluation, the treatment of the difference. Now let's assume that the fair value is 35 Ghana cedis, and then the current amount is 30 cedis. So therefore, there will be valuation gain of what? 5 cedis. How do you treat it? How do you treat it? 5. Current amount, you know that is the cost of the asset less accumulated depreciation at the date of what? At the date of valuation. Good. So that is it. Now let's look at the treatment, accounting treatment of revaluation difference. So accounting treatment of revaluation gain or loss. So I just have to add accounting treatment here. So let's start with the revaluation gain. First, if it's revaluation gain, what's the treatment? All of them two treatments, then you are done. First, add the gain to what? The current amount of the asset. So the first treatment will be add the gain to the current amount of the asset. Current amount of the asset. Add the gain to the current amount of the asset. Add the gain to the current amount of the asset. Good. Then 2. What is the other treatment? Now, the 2, we have 2A. So add the gain to the OCI or the revaluation surplus account. So the gain must be added. For this section is the debit. So first section is the debit. That we debit the assets. Debit the assets. Then credit the revaluation surplus or the OCI. So add the gain to the OCI. That's other comprehensive income. Other comprehensive income in your profit or loss. In your profit or loss, the other comprehensive income section. That is it. Which is same as what? Revaluation surplus. So revaluation surplus or revaluation gain account. Good. So that is the treatment. Any item that enters the OCI normally reflect the change in equity and again reflect on the financial position. That is it. Good. Just that here there was a general exception or it's a general deviation. Good. Except in a case, there's an exception to this general rule. So that's a B, treatment B. This is a credit section. This is a credit section. Good. That means credit OCI or credit revaluation surplus. We are done. Debit the current amount of the asset. We are done. So that debit means we are adding to the assets. Because the asset have a debit balance. When you add, you are just making what you call a debit entry. OCI revaluation surplus, all of them have a credit balance. So if you credit, you're making what you call a credit entry when it increases when you add it. Now, except situation where there's a previous loss. So except where, except where there is what? A previous loss. Except where there is a previous loss. Good. So that is the exception. So for this, I'll do illustration for you. No. Please take note of the exception. Most examiners like it. November 2017, I see it was there throughout to November 2018. So let's take note. Good. Now let's use our example. We had a gain of 5 series. So assuming that the calculation, revaluation gain or loss, revalued amount, we had 35, current amount of just an trial illustration, we had gain of 5 series, the revaluation gain. So first, we are saying that debit the asset carrying amount. So write the carrying amount of the asset. So assets, bracket the carrying amount. Already there's 30. So we are adding the revaluation gain to it. So it's a revaluation gain, which is 5. So therefore we get back to 35. In short, it's the same as what the fair value. So it tells you that right after valuation, the asset value will be converted to what? The fair value. Right after the valuation, the asset carrying amount will be transferred to what? To fair value. That's the treatment number 1. Treatment number 2, you go to your OCI and then record what? A revaluation gain of 5 series. We are done. So this is the treatment. This one will be in the P&L. Some goes to the financial position. Good. Then the B, exception. Yeah, let's assume that a year before this valuation or a year before they perform the valuation, the asset was revalued and they had a loss of, let's say, 3 series or 3,000. So there's a previous loss. So previous loss of 3,000. So let's make it 3 series. Previous loss of 3 series. How do you treat it? Yeah, there's a section here, except previous loss. So all what you have to do is this. Until the loss is cleared, no transaction or no gain to enter the OCI. Good. And then the loss, this previous loss, we've already recorded it in the profit and loss. So wherever that loss is, a portion of this gain, today's gain, must be released to go and offset the previous loss. So let's take it again. In a situation where there is what? Previous loss, until that loss is cleared, we cannot record OCI of 5. But the exception does not affect the asset section. No, it only affects what? The profit and loss of the OCI section. Good. So what you do is this loss was recorded last year in the profit and loss. So what do we do? Let's go there. So in that instance, we will have what we call in the P&L, we will record revaluation gain. We're using to offset the loss, which is 3 series. Then we go to the OCI. Direct the OCI and to record revaluation gain. So gain of what? Love it. The gain was 5. Now we've exhausted 3, so left with 2. So I record the remaining 2 here. Then we are done. So that's the exception to the general rule. That's the exception. So if the gain is 5, and then we've had a loss previously, that loss must be what? Cleared before any gain enters the OCI. What if the loss was, let's say, the loss is to, let's say, 12 studies. So it means that the gain is 5. Okay, we can offset 5 out of the 12. So still, left with loss of what? 7. So therefore, nothing goes to the OCI because again wasn't enough to offset all the loss. So the subsequently, if there's any valuation again the following year, then we have to offset 7 from there in that order. Good. So that's the end of the treatment of the revaluation gain. Now let's go to revaluation loss. Good. Revaluation loss. Revaluation loss. So treatment. So that's B. Revaluation loss. How do you treat revaluation loss? I want to do 2 treatments. One, first the loss, so subtract, right? So subtract it from where? The carrying amount of the assets. The carrying amount, that's from carrying amount of the assets. That's the first thing. Second, add it to the operating expenses or expense it in the P&L. Add to operating expenses. So it must be expense in a P&L. That's it. Treatment. So all revaluation loss must be expense. Revaluation gain must be treated as what? OCI, except there's a previous loss. Good. So here too, let's take a nice example. Assuming that the assets carrying amount, revalued amount is let's assume that the revalued amount is somewhere 50. The asset carrying amount is 65. So therefore, there's a loss of what? 15. So this is revaluation loss of 15. How do you treat this 15 in the book? He said first, subtract it from the asset carrying amount. Okay. So therefore, if I take 15 from 65, it will result back toward the asset revalued amount. So that is it. So therefore, it's confirmed the statements that we made previously. It states that after valuation, right after valuation, the asset value must be the revalued amount. So the current amount must be converted or restated to the fair value. Good. So after subtracting, so here to be 65 less 15. So the asset value now will be what? 50, which is the same as what? The fair value. Good. Which is the same as the fair value. Then add it to the operating expenses. So in your P&L, expense 15. That is it. Here to there's a section, the general rule. Except, so you are treating loss, right? So the exception will be the reverse. So except where there was what? Previous gain. So except where there is previous gain. So now we have a gain, but which coming from where? Previous valuation. So except situation where there was what? previous gain. So that one too. Until all the gain is collected, you can't tell yourself that you are losing. So let's assume that the same asset, they did valuation 2 years ago and they had a gain of 10. That gain will be where? Will be sitting in the OCI. So until we clear that gain, no figure should enter the P&L. So let's assume that in this situation, how do you do it? So there's a previous gain of 10 finances. Please, the exception does not affect the asset value. It only affects the OCI and then the profit and loss section. So here, what you do is this: if this is our P&L, nicely prepared, where would the gain be? To be in OCI. So we go to OCI first, and then we go and reverse whatever gain that we have recorded. So let's go there and reverse the gain. So the gain, the right revaluation loss, but now we have a loss of 15. So we are going to use reverse that gain. So I write 10 here, put in brackets, I will get it. So a portion of the loss must be released to the OCI to reverse the gain, because the gain will be in OCI. Then the remaining balance, we now record it in the P&L as well as an expense. So here, revaluation loss, we now record it in what? Operating expenses. The difference, the entire loss is what? 15. We've released 10. Left with what? 5. Good. So this will be the treatment. Meanwhile, the entire 15 be subtracted here, no breakdown. So that is it. Good. So that's the treatment of revaluation gain or loss. So we are done for revaluation. We look at how to calculate the gain or loss, and we look at how to treat. In fact, the revaluation gain or loss will also have effect on impairment. So how we treat revaluation loss, the same way we're going to treat impairment, where there's impairment loss. When you go to IAS 36, we know it there. Good. So that's the end of valuation. We are going to look at for some few items that we have to consider. Then we are done with the IAS 16, the tuition phase or the principal phase. We'll leave with the question solving phase. Good. But before that, normally the revaluation, there are two issues against revaluation. Normally they pop up when we are solving questions. The first one is transfer of asset depreciation. Transfer of asset depreciation. Transfer of what? Asset depreciation. And transfer of revaluation gain after disposal. I want to look at it when I do disposal. But just what we call transfer of excess depreciation. Now, first of all, there was something called asset depreciation. How do you calculate asset depreciation? Is the difference between the new depreciation charge per year, that's depreciation after valuation, and then depreciation before valuation. So now I call it the new depreciation. So we say depreciation after valuation, that's per year. So let's say depreciation per year, but must be after valuation versus less depreciation per year, but before what? Depreciation. So that is it. So what's the depreciation charge per year before the valuation and then after valuation? So if assuming that we have an asset, let's take a nice example here. Let us have an asset. We bought it 2010 here, but 2010, and then the cost was 100,000 at a cost of 100,000. So let's write the cost, very important. And then the number of years, 10 years. Good. Then but you bought it 1st January 2010. So this 1st January 2010. So on 31st December 2015, exactly 6 years later. 6 years, because January 2010, that's what you bought the asset. So 2010 full year. So 2010, 10, 11, 12, 13, 14, 15. So 6 years. Good. So that is it. So 31st December. So 31st December 2015, the asset was revalued with a fair value of what? Fair value of 60,000. The useful life of the asset remain unchanged. Calculate the asset depreciation. So let's see. I read this question to calculate for the asset depreciation and then to calculate the revaluation gain or loss, if any. Good. Now the depreciation per year will be, we have the depreciation before valuation. The depreciation for 2010, 11, 12, up to before 2015 December, in fact, up to 2015 December will be consistent. Good. So now let's see. I'll do small calculation here. So let me take this section off. We're looking for the calculation of what? Asset depreciation. We said there's a difference between the old depreciation charge and the new depreciation. Good. Now before that, let's see if we can calculate the revaluation gain. So calculation of what? Revaluation gain or loss. So to get the revaluation gain or loss, we need a revalued amount, which is same as the fair value. The set is what? 60,000 less the carrying amount of the asset, less carrying amount. How do you get the carrying amount? Is equal to the cost of the asset, which is 100,000, less the accumulated depreciation. Now, what's the depreciation per year? So it's 100,000 depreciation per year divided by 10. You get 10,000. So every year depreciation is 10,000. And now this is the old depreciation, 10,000 per year. That's the old or depreciation before the valuation. If it's 10,000 per year and then we travel for how many years? 6 years. So it will be 60,000, right? Good. So accumulated depreciation will be this 10,000 times what? 6 years. And that will give us 60,000. Great. So therefore, the current amount is what? 40,000. So therefore, revaluation gain will be 20,000. So it's again revaluation gain. Why? Because the fair value is more than this. Now let's go and then calculate the asset depreciation. Now the asset depreciation, we have to calculate the new depreciation. What will be the new depreciation? The assets have a useful life of what? 10 years. And then depreciation is on straight line. Now we've exhausted 6 years. So left with how many years? 4 years. Just that now the new value or the value of the asset will be 60,000. So therefore, the new depreciation will be or depreciation after valuation. But depreciation after valuation is equal to the fair value divided by the number of years remaining. So that is the depreciation. Good. Now let's see. So therefore, depreciation after valuation will be the fair value, which is 60,000, divided by the remaining useful life, which is what? 4 years. And basically, this will give us what? 15,000, right? 15,000. So every year, 15. So basically, the asset depreciation will be the 15,000, which is the new depreciation charge after the valuation, less the old depreciation of 10,000. So therefore, asset depreciation is what? Good. Will be 5,000. So now let's do it here. So excess depreciation will be the 15,000 less 10,000. That will give us 5,000. Or alternatively, you can also pick the gain, the revaluation gain. If the gain and divide it by the number of years, the remaining 2 years. So the gain is what? So, or revaluation gain of 20,000 divided by the useful life of what? 4 years. Which also give us the same answer, an alternative. Now we know how to calculate the asset depreciation. What left is the treatment. Now here it must be a policy of the entity to transfer any asset depreciation. So let the examiner inform us about the transfer of what the asset depreciation. So if the company is their policy to transfer asset depreciation, then this is the entry. Who are you transferring from and why are you transferring it to? Here we are transferring from the revaluation surplus. So from revaluation surplus, from revaluation surplus, and then to where? So first from revaluation surplus account, then to retain earnings. To retain earnings. Why? Because we assume that the revaluation gain has created or has resulted a higher depreciation charge. So therefore, let's transfer some to the retained earnings to reduce the asset depreciation that we have charged or to reduce any additional depreciation charge. So therefore, you go to in a change in equity, you take 5,000 from the revaluation reserve, 5,000 from the revaluation reserve, and then you send it to the retained earnings. Or in short, wherever this gain will go, this gain 20,000, wherever you're going to record it, 5,000 must follow. So we deduct 5,000 from this figure. Then we add the 5,000 to our profit, wherever the profit will be less than it, because as a result of this gain, we are charging depreciation of 15,000, no longer what? 10,000. So it has reduced our profit. So now let's pick that value from the gain and go and add it to the profit so that it will not worry our profits. So the comparison will be great. So that's the transfer of asset depreciation. So in short, subtract it from the revaluation surplus and add it to the income surplus or the retained earnings, and then we are done. Good. Great. Now we are done. Left with 3 issues. Then we are done with the IAS 16. 3 issues. So I'll list them down, then we keep them one after the other. Then we are done with the IAS 16. Good. 3 issues. 3 issues. Issue number 1, you have to look at complex assets. Complex assets. Issue number 2, derecognition of assets. That's the disposal of assets. That's the derecognition of assets. Then finally, the transfer of revaluation upon disposal. So revaluation gain the treatment when the asset is being disposed of. So it's like a subset of this. Then we are done. So first, complex assets. Complex assets. Now let's look at complex assets. Good. Now the standard define complex assets as what? They are the assets which are made up of separate components, and each component is what? Is separately depreciated over its useful life. That's the paragraph 13 of IAS 16. That's where I'm reading from. Good. Good. Now the complex assets, example include what? Aircraft, ship, crane, and then other large components or separate assets. Now let's give example. Good. Let's give example. Here I'll treat one example. The complex asset. In fact, if the components have a different useful life, it must be what? Depreciated separately. Then we are done. In fact, I'll add one item to it. Overhaul. Major overhaul. Normally go with the complex asset. Major overhaul. That's what I'll add it to the complex asset. Then overhaul. Good. They move together normally easily. Most of the complex assets, they need to be form a major overhaul on them on regular basis. Here it might be on regular basis, not just once a while. Regular. Every 3 months, every 6 months, every 3 years. Good. Now let's look at the complex asset. Example of a complex asset. So example of complex assets. I'll take them, go and take overhaul, do the disposal, revaluation gain on disposal. Then we are done with the IAS 16. So example of complex assets. Let's assume that we have the following assets. It's about aircraft. Aircraft, good. Dollars of now the components are, and then they are estimated useful life. So useful life. Good. And then here probably was the cost. So let me put it this way. Good. And let's set down. So let's assume that our aircraft have 3 components. What are they? But then it can be more than that. So 3 components. I'll talk about the exterior body. Yes, the exterior body. That is the exterior body. Exterior body. Let's assume that one is 40 million. This one is in million. This one is 40 million. That is the exterior body, 40 million. Then what again? We can talk about the undercarriage. So undercarriage. I wish I can. Great. So the undercarriage too, let us know is 10 million. For the standard body, the entire body, we call it what? Fuselage. Fuselage. Good. So that's the name for it. Sorry. Fuselage. That's the body. Then let's assume that the engines, the total value of the engines to 16 million. 16 million. Good. Now let's see the useful life. The external body will go in for or just the body, the entire body of the aircraft, 40 million, and then it's going for 20 years. So 20 years. But the undercarriage will go in for just an assumption, 500 landings. So 500 landings. Good. Then the engines also going for 1,600 flying hours. So 1,600 flying hours. Then we are done. Okay. So here it means that we can depreciate these complex assets on what? A component by component. Why? Because all of them does not have the same useful life, and each component run on its own. So that is it. So now calculate the depreciation. If for the first year, calculate the depreciation for the first year if the undercarriage ran for, let's say, 150 flights, and then totaling 400 hours, like the engine is working for 400 hours. So in a year, say it's the flight work for, let's say, 150, and then this work for 400 hours. Good. Good. So what will be the depreciation charge? Depreciation charge. So first, let's calculate the depreciation charge. So that the first year there were 150 flights. So it means that each flight landing will be one. So 150 will be what? 150 landings. Then we go to the engine. Engine 2,600 flying hours. Good. So therefore, what will be the depreciation charge? So let's see the calculation. So first, the entire body depreciation will be 40 million divided by what? 20 years. So let's see if we can do that one here small. So first, depreciation. Second, the entire body will be, let's put here, the entire body will go in for 40 divided by 20. And that will give us 2 million. Then the second part or the second component will also go in for 10 million divided by 500 times 150. Good. So times 150. Then we are done. So therefore, the answer will be, that is 10 divided by 500. That will give us 0.02 times 150. That will give us 3 million. So here will be 3. Now let's calculate for the last one and then let's see. The last one is the engines. The last component is the engines. So the engines too will be, the cost of engine is 16 million. Also divided by the entire flying hours. That's 1,600. So in short, to give us like 1 million times the 400 hours for the first year of operation. So therefore, 16 divided by 1,600 give us something like 0.01 times 400 hours. That will give us 4 million. So depreciation for the first year will be what? You sum them up and you are done. That will give us 9 million. So depreciation for first year will be 9 million. Then we are done. So that's the depreciation charge for component assets. So for component what? Assets. Good. So 9 million. So that's the first year depreciation. We are done with the component depreciation. So in exams, if the assets can operate, or if the assets have a different useful life for that of their components, then we can depreciate them separately. Then add a final answer. So what will be the carrying amount of the assets after the first year? The overall value of the asset is what? 50 million, 66 million. Then we less 9 million from it. Then we get a value. Good. Or you can find the carrying amount individually and sum them up. We also pick that. But we like the full amount. Now we are done with the complex asset. The next item, they normally move together. That is the major overhaul. Now, some of the complex assets, they required a routine overhaul, like aircraft. Every 3 years, it must go for major overhaul. Every 3 years. So here the standard is saying that we can depreciate the cost of the overhaul. We have to treat it like a component cost. So overhead will be also classified. That's the overall. Be classified as what? Component cost. So let's assume that this aircraft, every 3 years, they have to service this aircraft every 3 years, and the cost of service or the overhaul. In fact, it's not like a mere maintenance or a mere service. No, it's a major overhaul. Good. Let's assume that is the cost is 2.4 million every 3 years. So overhaul. So now what will be the depreciation charge? What will be the depreciation charge? Let's assume that after every 3 years. So every 3 years, every 3 years. So every 3 years, you have to incur what you call a dollar of, that's Ghanaian dollar, of 2.4 million. to perform the major overhaul every 3 years. So what do? Now it means that the major overhaul must be treated as what? As a component cost. And it must be depreciated what? Separately. And the depreciation must be based on the length of the next overhaul. So here they say every 3 years. So that means the life will be 3 years. Good. If it's every 2 years, the life will be two in that order. So here, I want to continue. That means the depreciation, we have to bring the overhaul. So let me continue here with the depreciation. So if I should continue here, I'll write well here, open a brackets, the 2.4 divided by 3, and that will give us 2.4 divided by what? 3. Good. 2.4 divided by 3, that will give us 8, 0.8 million. So it means that 0.8 million will be the depreciation charge. So this cost must be added to the cost of the assets. Yes. And then the 0.8 will be added to the depreciation. So overall, the total depreciation will be 9.8 million. That's the depreciation. So in short, major overhaul must be capitalized as cost of the asset and must be depreciated on its own. Then we are done. So we are done with the complex assets and then the overhaul. Now let's go to the derecognition of assets, and that's the last stage of the IAS 16. Obviously, we've looked at the initial measurement, where we've looked at the recognition, where you got the PPE first, how do you record it? We've gone through all the stages, going to the complex asset cost model, revaluation model. Now we are ending it. What if, at what instant do you stop recognizing the assets in your books? So that is it. So that we call it derecognition of PPE. Let's go to derecognition. We are down to recognition and derecognition, where the PPE must vanish from your books. Yes, where the PPE must not be recorded. So at what point do you stop recognizing the PPE? So we call it derecognition, right? Good. Derecognition. At what point do you have to stop recognizing the asset? Here we are saying that when the economic benefits cease to flow to the entity, you have to stop recognizing the assets. Yeah. You have to stop recognizing what the assets in your books. If the economic benefits also stop flowing to you, so you have an asset at a point in time, you decided to pass it on to a different person or through lease or through disposal, sold it. So you are saying that stop showing the asset in your books because the benefit does not flow to you. The most proper form is the disposal, when you dispose of the assets, so disposal. Now, there are so many ways of disposing assets, so many. Let's see some few of them. Disposal by sale. Disposal by what? By sale. Yes. Disposal by distraction. Disposal by distraction. Good. So by distraction. Yes, you can also buy pro bono as like donation. Good. So donation. Donation. Good. Great. So these are the three possible ways by which you will dispose of your asset. And any of them, stop recording the asset on your books. So that is it. And then you can also transfer. Transfer. So let's look. Let me add some two. Transfer. Transfer. This transfer, in fact, I'm talking about lease. You've leased the asset out to someone else to use the asset. The asset must not be recognized in your book as PP, especially if it's on finance lease. Let me be specific here. Finance lease. That is it. Finance lease. That's how it's not on. Finance lease. So don't need to worry. Finance lease. That one too can also cause a derecognition. Now the most popular one, or the one that we normally include in questions, is the disposal by sale. So when you say this, the asset was disposed of, normally mean the asset was sold. So that is it. So you're going to look at the disposal by what? By sale. That's all. So as soon as you dispose of your assets, you have to what? De-recognize the assets, and then you are done. So now let's look at the entry. So the steps, entry. If you dispose of the assets, these are the steps that you have to go through. So steps in disposal. Steps in disposal. That's the accounting for disposal. The accounting treatment. Step one. Step one. Record the cash or the proceeds. So record the proceeds. Add the proceeds. Add the proceeds to the cash book or your cash balance. Cash book. Add it to your cash and bank balances. The cash and bank balance. 2. Only 3 steps, then we are done. Step 2. Calculate the profit or loss on disposal. Determine the profit or loss on disposal. And then the third one, normally call it do the thing. Yes. Do the thing. What do I mean by the thing? Do the remover. I call it remover. That's the derecognition section. Cost from cost, accumulated deviation from accumulated deviation. All the details of that asset must be cancelled from your book. So that's the remover. Remove the details of the assets. Cancel all the details of the assets from the books. And then you are done. So that is it. Now there's a small format for this. So the format will be, if you want to determine the profit or loss, 2 items. First, look for the proceeds. So the same proceeds that you've added to your cash, bring it. And less the carrying amount of the disposed assets, then you are done. So let me repeat again. Step 1, add the cash to your cash balance or your bank balance, or the proceeds to your cash balance. What if you sold it for pro bono, or it was a donation, donated to maybe any home? You know, some of the organization, when their assets become a bit older, they donate to some of the homes or any NGO. Good, around. So if it's donation, that there's no proceed, the proceed will be zero. Or sometimes by distraction, some of the assets are after the end of the useful life. You cannot sell it. No one will need it. So the best way to distract it, yes, accordingly, the explosive chemicals or the, I think they have dynamite. And you have other harmful assets with you. At the end of their useful life, no one, so you have to dispose it of properly through distraction. Good.
That's when that asset does not have what uh, sale value. Then the second step, calculate the profit or loss. The profit or loss, the format will be, let me see if I can do the format here. So the format will be the profit or loss, the format will be first. So profit or loss on disposal. First two items, the proceeds, how much you sold the asset for, so much. Now less the carrying amount, less what? CA, carrying amount. That's all. We're done. Now if it's a profit, you add it to other income. If it is a loss, you add it to operating expenses. So here, before you calculate your profit before interest and tax, make sure that, or before you finish your operating expenses, make sure that you've calculated it and you certify yourself whether to be profit or loss. Because if it is a profit, it will be in other income. If it's a loss, it must be added towards the operating cost, and then we are done. So that's the profit or loss on disposal. And then the remover. Remover simple means all the details of the disposed asset must be cancelled from the books. How do you do the cancellation? So you credit the entire cost. So let's assume that you have PP, the total PPs that you have, or the plant that you have was a plant. The entire cost of the plant will be, assume that the entire plant is 200,000. That's the cost of the entire plant. Removal means the cost of the disposed plant. So disposal, and this will be done in the PPE schedule. So disposal, come here, and then maybe you sold 50,000 of the plant. So take it off. The remaining balance is what? 150. Good. So I'll summarize all this in a nice PPE schedule, and that will be the game. So that is it. So cost from cost. Then you go to accumulated depreciation. So this is the cost section. This is the cost section. We'll go up a bit. And then accumulated depreciation. Let's assume that the accumulated depreciation of the entire asset is an assumption. Um, it's 100,000. Then accumulated depreciation of the disposed asset is assumed to be 25,000. So therefore, the remaining will be what? 75,000. So this is what I mean by what? The remover or the thing. Do the remover. That is the meaning. So take all the details of the disposed assets from the entire. Good. We are done. Now, sometimes I mention revaluation. If you have performed revaluation and you have revaluation gain on a particular asset and you dispose that asset from the books, now the gain, the entity have two options, either to maintain the gain in the OCI or to maintain the gain in the revaluation gain, so in the revaluation surplus account, or to transfer the gain. So let's go to that one. So upon disposal, so this asset that you've disposed of, if there's any revaluation gain coming from that asset, revaluation gain coming from that asset, you have two options. Option one, option two. Either you maintain it, so maintain in the revaluation surplus account, or you transfer to the retained earnings. So these are the acceptable treatment. Let us know this asset that you dispose of You revalue it maybe 2 years ago and you had a gain of 30,000 cedis. So there's a gain sitting in the revaluation reserve or revaluation surplus. So, but this asset, you dispose it off. The standard is saying that don't worry, you have two options. Either this gain, you maintain it in the revaluation surplus as it is, or transfer this to the retained earnings as what? As realized gain, and then you are done. Good. Now let's look at the last aspect. The last aspect is we are going to prepare what we call PPE schedule. We summarize all the PPE that we have. We prepare just one working, just a one workings that we will do. So we call it PP schedule. PP schedule. Good. In a PPE schedule, you list all the PPEs that you have, all of them. For the class by class, it will be a class by class, not like individual PP. No. So we start like this. Maybe I have land and building. I have plants and machinery. Maybe I have motor vehicle. Good. Then finally, I record the total here. How we get it? Good. Don't forget your currency, your reporting currency is CD or dollars. Then you start with the cost of the asset first. You align it like this. Then you tell the examiner open balance. Open balance of the asset. So much, so much, so much. And then you sum them up. This and this. If any of them is not in a trial balance, it was acquired during the year, you don't need to bring that balance. Meaning that asset was acquired during the year. Good. Then from the open balance, you go to additions. So additions. Additions will be in the form of what? Purchases, form of transfer receive. Transfer some assets from different branch to a different location in that order from subsidiary A to subsidiary B. So additions, that's the purchase basically. Any of them that you acquire, maybe you bought new plants during the year. So the total will be, I didn't acquire, here will be dash dash. The one that you acquired is an assumption. Then disposal or transfer. So disposal. So this is where you are doing the removal. Here the cost of the disposed assets. Maybe you dispose some of your motor vehicles. So you write it here, the cost. You put it in brackets. The same figure must be, these are the total section. So that's the disposal. Then if you have any revaluation gain, bring it. So revaluation gain or loss. Let us know you do the valuation on the building. Land and building was revalued. So you had a gain. If it's a gain, add. If it's a loss, we say subtract. If it's a gain, revaluation gain must be added to the cost or the carrying amount of the building. You are done. So you go through all this. As soon as you are done, dash, dash, the gain must also come here. You underline it. Then you sum them up. But let me do it this way so that I can get some space to do my align. Then align it once, not double, once. Just once. Then you total vertically and then horizontally. All these two vertically to this section to give us the same answer. That's the total cost. We call it closing balance. So right here, closing balance. Then you relax. You come back again for the second half. Then write accumulated depreciation here. Until for the same game. So I may end up shifting this total up. So let me shift it up, the closing balance, so that I can do the accumulated depreciation there. Good. We can take a snapshot of it. Only take a snapshot of it and then we see. Good. Now, so this is the cost section. So I'll shift this total up a bit for us to continue the game. So that you see. So let's assume that is the cost, the closing balance. So closing balance. I know how we arrive at the closing balance, meaning we added something on top of it. So right from there, you write here accumulated depreciation, and you underline it. You come down, open balance. So open balance. So much, so much, so much, total, so much. They say charge for the year. Charge for the year. Depreciation charge for the year. So much, so much, so much. And then their total. Then finally, you record what? Disposal. We said that cost from cost, accumulated depreciation from accumulated depreciation. So this is the accumulated depreciation section. This will be the accumulated depreciation section. So disposal. Maybe they sold vehicle. So dash dash the vehicle that they sold. You put in brackets. You underline it. You underline it. Then we are done. So here must be total subtraction. Now let's see something here. So just the accumulated depreciation section, you sum them up, get overall total. Then write your closing balance of the accumulated depreciation. Then you relax, come back again for carrying amount. Finally, we record the carrying amount here. So carrying amount. The carrying amount will be, if you take the cost one, subtract the accumulated depreciation from it. So cost, the total of the cost, less the total of accumulated depreciation, put it here. Total of this cost, less the total of this, you put it there, then you double underline it. Good, in that order. Then you get overall figure. Good. So at the end of the day, this figure is what you're going to present to the financial position as your PP. One figure representing all the PP. That is the end of the game. And that is the end of IAS 16. Good. If you do have any question, any comment, challenge, addition, kindly add it to the comment section. We will pick it up and then work on it. If you have not subscribed, kindly subscribe for us and share the link. Good. So that is it. But please join us when we are doing the question solving stage, so that this is just the principle. What left is the practice. So we will start with the question solving, then fine. Okay. So the next standard that we are going to treat after the question solving will be IAS 40. So next will be IAS 40. Thank you very much. Once again, this is Target Professional Consult. And then this is Targets. Good. Goodbye, everyone.